Investors and traders, welcome to the general market chart pattern. Today is 7th of October 2023, and I hope everyone is having a great weekend. In this video segment, we are going to take a look at the key US stock indices, as we always do for this video segment. We'll take a look at the S&P 500. We'll take a look at the cash market. That's how we'll start. We'll also take a look at the futures market, which will be the ES mini futures. We'll take a look at the NASDAQ 100 futures, NQs. We'll briefly take a look at the YM, which is Dow Jones Industrials futures, E-mini futures, and also RTY, Russell 2000 E-mini futures. We will also take a look at the debt markets. Mainly, we'll take a look at the 30-year US Treasury bond, and we'll also take a look at the 10-year Treasury note market. In fact, we will start by taking a look at these markets first, and if we have time towards the end, we'll also take a look at the dollar index, because we need to take a look at all these markets, because it is a big flow chart of cash. So cash keeps on moving from one market to another, so we need to keep an eye on all these markets to be able to make an understanding of what is happening and what are the key patterns being formed in each one of them. Okay, so let's take a look at by taking a look at the 30-year bond future. So this is the daily chart of the 30-year bond future. Is also known as the long bond future because of its duration, which is 30 years, pretty long duration. And the way the bonds work is that if the price for the bond is falling, it means the yield is rising, which is an indication of higher rates to come. And when the price is actually rising, it means that the yields are falling, so more of a situation where the interest rates are likely to fall. So in this, what we have been seeing is that this market has been in a tremendous bear market, which started quite a while ago. So we have to go back to about 2020. That's when the bear market started for this one. And what we have seen is the interest rates move quite a lot in those about 3 years time, a little over 3 years, because of the actions of the Fed. And also the market has been dictating this by a continuous fall in the price or the rise in the yield. So the bearish symmetry still remains in this marketplace, but what is really important is something which we also had a look at in our previous video, which is this weekly chart. And here I want to point out this key level of 78.6% Fibonacci retracement coming in from these really long-term lows going back to about year 2000. So we are right there. We are actually testing this level on the weekly basis. The candle is still negative, but this could also be in an area where the market could perhaps find some support. So the next week and a couple of weeks, in my opinion, is really important, because if the market does begin to rally from here or find a good amount of support, it could be a pretty important support which could last for several months. Ultimately, we also have some lower price in the region of about 106 to 103 as well, but for now we are concentrating on 110, and the reason is because of what is happening in the Treasury note market for the 10-year. So this is the daily chart of the Treasury note market. Similar kind of pattern formation, but it's a little bit different. It's a different market. It's a much bigger market than the bond markets. And a 10-year is something which influences pretty much everything. Auto loans, credit card loans, it really has a huge impact on consumers. And also because of its longer duration, it's not something which is quite regularly influenced by Federal Reserve's actions, which tend to be more on the shorter side of the rate curve, yield curve. So this market, what it has done as of last Friday is that last week it went and tested against this 106 level, which is also the 1.272 Fibonacci expansion of this entire range. But the important thing is that we had a nice rally in this, then we had a little bit of decline. And last Friday, what we have seen as of yesterday, meaning 6th of October, price action. The price attempted to move lower but rejected lower price. So it has formed a low which is higher than the low of 4th of October. And this is something important to note. Now, in the 30-year bond futures, it hasn't done that. It's a different price action. But because it has done this in in the 10-year Treasury note futures, we need to make a note of it, and whether this level begins to give important support based on the price action. It's going to be something really important to watch, because it could be the start of at least a pretty decent rally which could last for a few months. And if that rally begins to take out certain key levels, then perhaps it could be something more than just a rally as well. So there is a potential even for that. So we will keep on watching our numbers. So here, what we have seen in this segment is basically every time the market has rallied by about this much, we have seen the market then begin to sell off. So we'll keep an eye on about 109 level for this market right here. And of course, we have the 38.2 percent Fibonacci retracement around the 110 or 111 level, and this one was, 109 level. So that's another key level to watch. And then this bigger symmetry, let me just bring this over here. This is gonna be the real key for this market. If the market is able to take out these 114 level to the upside, of course this top of the range becomes the next target, but also it will be an indication that perhaps we are getting out of this bearish phase by breaking out of the bearish symmetry, and this rally could in fact have more legs to it. So that is how I would interpret the price action, but we'll have to wait and see how, should we get a rally from should this support level get held and we begin to see a pretty decent rally from here or not. Now let's move to our S&P 500. So this is the SPX, this is the cash index. So the pattern we had been watching for was this ABCD mentioned in blue figures here, letters, right at the 78.6% Fibonacci retracement. We also had this ABCD completing there, and when we have a confluence of two or more patterns coming together or ratios, then we need to pay attention to that. So here, what we discussed was that either if the market is strong and is able to take out these level convincingly on closing basis, then chances were that it's going to go and challenge the all-time highs, maybe even make a new high. Else the market was likely to go into a correction, and this is the latter part that we have seen. The market did in fact go into a correction. Then the next pattern that we had been watching for was this ABCD 1-to-1 price projection, and also watching this 38.2% Fibonacci retracement, and also this nice trend line. So we had a confluence, a number of things coming together. Now the market did not reach exactly at the 38.2% Fibonacci retracement, and we have seen a nice rally or a bounce at least coming off this trend line very close to this ABCD price projection as well. So let me try to blow this up here. And now where the market closed on last Friday, it's right at this 38.2% Fibonacci retracement, just a little above where the market closed. We have this resistance. This could prove to be some good amount of resistance for some amount of time. We have to wait and watch the price action, and of course, if you have been watching the news, the some of the geopolitical events happening, perhaps that could have an influence on the price action, and maybe we are able to see this 38.2% Fibonacci retracement around 4180 or 4182 level. Maybe the price actually does trade there, and that's where we'll really have to watch the price action, how the market will trade there, whether it's able to convincingly penetrate through it on at least two consecutive daily basis, or that level provides a great amount of support. We'll have to wait and see. But this is what we are seeing in terms of price action. We were expecting a support to come in around this region. We did get that. Now the market is right at the resistance level of 38.2% Fibonacci retracement, around 43.37 on the cash market. Let's take a look on the E-mini futures. This is the S&P 500 E-mini futures. Similar kind of price action, but of course it's a different market. It's not the cash market, so the levels are a little bit different. Another good thing is to see is that we also had this 200-day moving average come in right here. That also has provided some support, along with some decent trend line, which I haven't drawn here. Again, the 38.2% Fibonacci retracement comes around 4200 on the S&P 500 E-mini futures, and 4182 is the number that we're watching on the cash market. Let's take a look at the NASDAQ 100, so the NQ's futures market. So here again, it had completed this ABCD pattern formation mentioned in this highlighted in blue, in black. And then we had some other pattern formations also completing nearby, and of course the 78.6% Fibonacci retracement. This market had been pretty strong this year. This is the market which was weaker in 2022 and was leading the other markets down. And this market has been a leader. So tech has been a leader this year in 2023. So something interesting. And here what we were watching for was also, we were getting right into this. We were initially thinking that perhaps the market would get down to about 14,350, where we have this ABCD pattern completion 1-to-1 price projection. I haven't labeled it the ABCD, but this is the 1-to-1 price projection that I'm talking about. So this market has been stronger, as it has been a leader this year. So what it in fact did was it formed a double bottom here. So you can see this one, and then a retest of this, and rejecting lower price and move higher. Let's see where this market closed, and this market is a little above its 38.2% retracement for this segment or swing, and from the highs here is right around 38.2% Fibonacci retracement. So again, it's in that zone right at the 20-day moving average as well. And the other level that we were watching for was 14,350. Maybe it might still have a chance to actually test that level, and below that we have the 38.2% Fibonacci retracement coming around 14,050. So those will be the levels that we're watching for. And then we have these nice 200-day moving average rising, and the market is way above 200-day moving average. That just shows that how strong this market is. In the ES, we saw that the market did retrace back to 200-day moving average and found support from that. So this is what we're looking at in the NASDAQ 100. Let's take a quick look at the E-mini Dow Jones futures. So E-mini Dow Jones futures, they have also been pulling back, and where they found support was from the 61.8% Fibonacci retracement of these lows right here. There's a possibility, as we mentioned, some of the geopolitical events happening, maybe because of that, who knows. We'll have to wait and watch the price action. The 78.6% Fibonacci retracement come around about 1,000 points lower to where it is at the moment. The rally in this market has been weaker compared to the S&P 500, and also in particular to NASDAQ 100 NQ futures, because it didn't even retrace to about 38.2% Fibonacci retracement. Let's take a look at the Russell. So the Russell one we would like to take a look at on the weekly chart. So what we can see is that Russell, it has been in just a tremendous trading range for quite a while now. a little over a year. It's just been in this range, and what we have seen is that it forms a double bottom here, rallies, there's a double top, then another top formation here. So it rallied and went and tested the highs of the range, and then now it's testing the lows of the range, but it's right at the 50% retracement of this, moves from the March of 2020 to the highs in November of 2021. So I don't know how long it can remain in a rectangular formation, i.e., a trading range. Normally, a trading range pattern can, last for quite a long period, more than it could last more than one's patience, in other words. So we'll really have to wait and watch and see which direction it will move, break out, when it does in fact finally break out. And again, we are looking at the weekly charts. This is quite long term time frame. So this is what we are watching for in the key US stock indices that we like to follow on this channel. And these are the levels that we are watching for. These are the key pattern formations that we're watching for, and I hope that you guys found this video you found value in the video. And if you did, please give it a thumbs up. And if you like the way we do the technical analysis and pattern recognition, and you find it of educational value for yourself, then please do think about subscribing to the channel. And if you do, then please hit that bell icon button. That way you will know when the new videos are posted, so that way you will not miss out on a new market commentary and some of the other segments that we do, where we follow some key US tech stocks. I did a video about that yesterday. I'll put a link towards the end of the video on this. Please do have a look at that. So thank you very much for watching, and I wish you have a great weekend. Good luck and good trading.